Hey guys, welcome back to our channel. So we'll be talking about the advanced settings of the filter category. If you're new to our channel, make sure you subscribe and join the Panda team. We have all of our social media links down below, so make sure you check them out and follow us. We will really appreciate your support. So the first filter that we have in the advanced settings is if you should include the stablecoins in your portfolio or if you should not. Stablecoins are cryptocurrencies that are patched to stable assets at a 1-to-1 ratio. Designed to maintain stable value, these coins tend to experience lower levels of volatility. They have practical value and they're designed in a way to be easily integrated in your everyday life or daily transactions. Some of the most famous examples include Tether, USDC, Gemini Dollar, and TrueUSD. Stablecoins really combine the advantage of fiat currencies and cryptos. They work as a hedge against a volatile market and they enable easier crypto trading and arbitrage. Finally, they also aim to have most optimal coin traits such as price stability, privacy, censorship, resistance, and scalability. So the major question here is why we should include stablecoins in our portfolios. So the answer is to actually benefit from the volatile market. The market phase of crypto right now can also be characterized as the range-bound market. This is a type of market where the price bounces between two specific price points, low and high. The high price acts as a major resistance point that the price cannot break through, and likewise the low price acts as another major support level that the price cannot break. When you have a market like this, you may want to include stablecoins in your portfolio because when you rebalance, when the prices are low, you use cash to buy more coins so the acquisition cost goes down, and when the market is high, you rebalance and trigger selling your cryptos into stable coins, which gives you more profits. So in this case, you need to really incorporate your subjective knowledge. So if you think that the market is directional, so it moves in one direction, then you might not want to include stable coins. On the other hand, if you think that the current phase of crypto is characterized as the range-bound market, then you might want to include stable coins in order to really benefit from volatility. So next one we have if you want to include Ifos in your portfolios. So forks are the coins that are derived from original Bitcoin blockchain, but due to a significant difference in the protocols, they've been forked off. The owner of an original Bitcoin receives another coin after the fork. Some examples include Bitcoin Cash, Bitcoin Gold, Bitcoin Diamond, etc. So to think about the forks from economics perspective, you have just one asset which has been forked into two, and in efficient market, the value of those two coins that were generated now add up to the value of the initial coin. In the perfect scenario, the value of these two coins will actually surpass the value of the previous coin. However, you have to also think about the worst case scenarios in which the pre-fork value actually exceeds the value of those two coins that were generated. So that really happens when the coins that are created are not really worth much, so they really lose value. So this tool is really giving you more power to decide if you want to keep Ifos in your index or not. The thing is that some Ifos are very manipulative, meaningless and skeptical, while others are very successful and powerful. So it's really up to you if you want to include them in your index or not. The next we have blacklisting. We already touched upon blacklisting in one of our previous videos, so I'm just gonna put a link down in the bio, so if you guys missed that video, you can rewatch it and see what blacklisting is really about. Shortly speaking, blacklisting really allows you to remove a coin from an index. For example, if you want to create an altcoin index, you can simply type Bitcoin in the blacklisting filter, get rid of Bitcoin, and create an altcoin index. It's very convenient, very easy to use, and you guys should really watch the video to learn more about blacklisting and some of its benefits. Finally, we have a filter which allows you to select assets based on how long they've been traded in the secondary market. So as crypto is in a very nascent phase, there will be a lot of projects introduced. So from the investment perspective, some investors might want to have assets in their portfolios which are stable, reliable, have proven to be successful. So if that's the case, you might want to choose assets that have been traded in the secondary market in more than a year. On the other hand, if you're an investor who's looking for new options and is interested in new projects, you might choose more than 1 month. So this filter is here just to make sure that you have a choice to guarantee that the assets included in your portfolio are stable, legit, and do not really belong to some pump and dump schemes. Thank you so much for tuning in, guys. I hope you really enjoyed the video. Make sure you comment, like, and share it with your friends. In the next episode, we'll be talking about backtesting, so make sure you tune in. Turn on the post notifications on, so whenever we post a video, you'll be the first one to get notified about it. Thank you so much, and I'll see you guys next time.